Let's dig into the weakness that we're seeing within the financial group, even on the back of better than expected quarterly results from Goldman as well as Bank of America. But you can certainly quibble with the quality at Goldman, and certainly investors are doing that. Our next guest is actually spending a lot of time doing homework within the financials, looking for opportunities. Let's bring in Chuck Lieberman. He's Chief Investment Officer and Managing Partner at Advisors Capital Management. Chuck, thanks so much for being with us. A lot of stress and anxiety about what are the financials going to tell us about the health of the financial system and their ability to perform against that backdrop. On that measure, what has your key takeaway been of these bank stocks?
Well, unfortunately, we're right in the middle of the reporting season for the banks. We've gotten data from the large banks, and as expected, they saw big deposit inflows coming presumably from the smaller banks, which haven't reported yet. And that's where the stress is. The expectation is that the smaller banks are going to see outflows. They're going to report deposit outflows. That'll put their balance sheets under a bit of stress. And the question is, has the market already discounted all of that stress?
I would say, though, that has been the narrative going into it, but not necessarily what has shown up in results. For example, PNC managed to grow deposits a little bit. Bank of America, the big money center bank, saw deposits pull back from last year. So there's a little bit of kind of muddling out there. Is that maybe why we're not seeing, at least today, kind of that big rush into Bank of America, even though they were able to deliver in other areas of their business?
Well, I think we had a big bounce after Friday's reports of some of the major banks, and those were much, much better than expected. Now we're just bouncing around. I think the ultimate test will be as the smaller institutions report, because those are widely expected to show sizable declines in deposits, pretty much across the board. It won't be as muddled as for the larger institutions. So that's where the rubber hits the road, and that's where the concern is that if they see lower deposits, they can't afford to lend as much, and that'll hold back investment in housing and real estate in particular, which are large focuses for those regional banks.
Are you buying bank stocks today?
Well, I bought a bank stock just a week ago. I put some more money into the sector. We bought shares in Fifth Third, which is a large, relatively safe regional. We see it as ultimately a beneficiary of what's going on. So, yeah, we see the banks as offering very, very good value at prevailing prices.
Fifth Third's going to report in 2 days on anxiety issues like loan growth and deposits. You think that there's a good chance that they're able to show some strength?
Well, I think that the stock already discounts a lot of weakness, more weakness than I think is deserved.
Within the financials group, there's a lot of concern about real estate exposure. We talked about this at the top of the 10 o'clock hour, that we're going to start to hear more and more banks talk about things like commercial real estate and their exposure there. How are you thinking about that piece of it?
Well, there's no doubt that commercial office space is very weak in the U.S. We're seeing weakness pretty much across the board. Obviously, work from home is part of the problem. Rising rates is another part of the problem. So that part of the market is very, very weak. But as a REIT analyst I read recently argued, that represents 3% of all commercial real estate. There are lots and lots of other sectors within commercial real estate. Everything from shopping malls, shopping centers, industrial properties, apartment properties. There are healthcare. It's a very, very diverse sector. And we don't find any great value in the office space. We think there's some risk there. I have done a little bottom fishing in that sector with Vornado. So we have some exposure. But the opportunity, the largest opportunity that I see is in healthcare, specifically in nursing homes. That sector got decimated during the pandemic, of course. And since then, it's been coming back. Occupancy is recovering. Their biggest problem is it's tough finding workers. They're having to pay more for workers, and government payments for nursing homes is rising, but just not rising very quickly. So that's put some pressure on profitability.
Let's talk
But this
about
is a
one of, well, I just want to use a stock as an example of one of those ideas. Your holdings, Omega Healthcare, I think is a play on what you're talking about, a dividend yield of nearly 10%. Is that sustainable?
We actually own Omega. We think that dividend is sustainable, and we expect the situation there to continue to improve. Rising occupancy, rising rates. Ultimately, we think this will pay off in a big way.
And generally, people look to the REITs for income, which is a major part of what you do. You manage an income portfolio. What is the risk reward of buying a REIT right now that yields, say, 6% versus just putting it in, what's been popular to do, at least to talk about, is just a 6-month T-bill?
So in the case of a 6-month T-bill, you're locking up that yield for 6 months. So in 6 months, if expectations of a recession prove to be accurate, 6-month T-bills will then yield much less than 6%. In the case of a REIT, that business is not going away. The ultimate growth of that business will provide more cash flow. And there are lots of companies in that yield range, 6% give or take, where we expect to see solid growth over the coming 5-10 years. So we think of REITs as vastly more attractive than treasuries. That's not to say you should ignore the treasury markets. It's obviously very safe. It provides a high level of assurance to investors. So people who are nervous about market fluctuations ought to have some of their portfolio in very safe fixed income. But as Silicon Valley proved, just buying long-term safe treasuries is not safe.
That's